TheoTrade. This is Don Kaufman, May 7th, 2021, doing the weekend update here on a Friday afternoon with the S&Ps closing up in today's trading session, some 32 handles. Pretty much the entire week, it came down to today's job numbers, which brings us to kind of the theme of this weekend's update: jobs, Fed, and a market of denial. Let's actually get to work and give you kind of a quick market update, a bit of a market recap. And we're actually going to forge forward. There are some incredibly important insights that I'll be providing throughout the course of this weekend's update here. I think it's fairly critical for those of you carrying positions. Doesn't matter whether you're long, short, whether you're market neutral. We are on the edge, people. All right, jumping into the market update. Now, all-time high. But what is the driving force behind that? You know, it's easy enough to take a quick glance at any given marketplace, and here are the S&P futures, and whether you want to look at the S&P futures, whether you want to look at the spiders, the SPX, people, it's all the exact same animal. And if you take a look at the SPY or the SPX, and it obviously breaks to the upside. To me, one of the better ways to kind of delineate some of the moves are to actually use the SPX. And this is exactly why I wanted to bring this up. I want to use the SPX and just give you a quick feel that, first of all, the SPX has been, and I just keep zooming tighter and tighter here, in incredibly tight range. So, in fact, if you have to actually go back until, roughly speaking, mid-April to actually see the onset of this range, and that range has centered specifically right around 4180 in the SPX. All right, well, we're clearly and decisively outside of that range with the break to the upside, and that was specific to today's trading session. Now, I'm going to come back to more of that a little bit later, right? Because, again, we've had this incredibly tight range inside of the broader marketplace. Okay, neither here nor there. But what's the driving force behind the S&Ps? And this is something we're going to elaborate upon quite considerably. It is unequivocally the financials. Now, the financials also kind of team up with a little bit of the energy sector. You realize that the XLE, the little engine that could, that's actually my nickname for the Russell. Nevertheless, the XLE on a year-to-date percentage is up, you know, north of like 40%. But the energy sector alone is not going to get it done. This is much more about, okay, the financials. The financials are the driving force. You go, but what about, you know, the NASDAQ had a stellar day? Really? Because the NASDAQ had an absolutely horrific week. In fact, the interesting irony, and again, we're going to look at this a little bit later, the interesting irony is not only did the NASDAQ have a bad week, but it actually closed the week lower even with today's rally. So it's important to just look back and just say, hey, what's the driving force? Evidently, it's the financials, and the financials along with energy. The next aspect, and I'm only going to spend a moment on this, the Fed's message to the markets on equity valuations. The Fed came out, okay, throughout the course of this week, and they had a paper that they wrote that effectively, all right, looked at the metric of equity valuations in light of everything that's occurred, and simply stated that they're astronomical. I mean, that's to put it politely. One of the surprising aspects here is how many people kind of expected that to move the market. It's not going to move the market, right? Listen, the Fed is telling you, though, something, okay, in this that I think was largely missed. So they're actually saying, the Fed themselves actually said equity valuations are, you know, for the most part lofty, and we could, you know, possibly expect a bit of a shock to those equity valuations, okay? Read between the lines. What the Fed is actually indicating is they're not going to be there necessarily to bail out markets, and that, you know, the inflation drum just starts beating louder and louder and louder. In fact, we're going to talk about the inflation drum here momentarily. Nevertheless, you know, when the inflation drum starts to beat louder, you have to realize that equity valuations are feeding, okay, some of that. So the Fed is actually using this paper and using the rhetoric in this paper to kind of talk down equity valuations. The irony is the market just did not listen. Okay, that's the only takeaway from that, is you shouldn't be surprised the marketplace didn't listen. It doesn't listen to anything lately. Okay, except of course, well, the next point over here, the jobs numbers. Okay, if you are gonna miss miss really, really big. So there's nothing to show in the jobs numbers other, okay, than some of the price action inside of the marketplace. Now, this is a little bit of a tell. So when I say the jobs numbers and the miss big, listen, the jobs number came out, added 266,000 jobs. What it missed, almost 1 million. Okay, 1 million is what we're shooting for. What did we get? 266. But the other entertaining aspect of that is they revised the number down pretty considerably for the March jobs number. Nevertheless, okay, price action of the marketplace still higher. There's no surprise yet. Still, again, no surprise. The price action, though, inside of the S&Ps, and the reason I want to bring this to your attention, the S&Ps, literally the minute that this came out, they had a move from 42.10, a quick reaction all the way down to 41.95, 41.96. All right, so why point that out? Because this is not about the S&Ps. This is all about, okay, the credit markets. This is about the bond market. The bond market actually had an absolute, okay, tsunami of a move on this particular number. I mean, we actually traded 158 and 20 ticks to 160 and a half, and then literally lost all of it and then some on the trading session. This is actually one of the largest ranges that we've seen really in most recent trade. I mean, if you look back on the year, there's not too many moves that have actually been this substantial on the year. The bonds were absolutely rocking, and of course you can get a feel for that as well inside of the volume out there. Again, the bonds though are literally, okay, they're grappling with the idea, and I just want to lay the tracks because we're going to talk about this more here in a moment. The bonds are grappling with the idea of inflation or could be a slowing economic recovery. And they're caught kind of between a rock and a hard place. And you get the feel, okay, of just that. Like when you start thinking about the move in the bonds, you realize they're like, oh, wow. So why did the bonds explode higher? That would have taken interest rates demonstrably lower. All right, which in fact is what the initial knee-jerk reaction was. You're like, oh man, the marketplace is going to fall apart. But then you get lower interest rates. The lower interest rates immediately, they hammered the financials in pre-market. You do realize the financials actually finished what? Higher on the day. At the exact same time, okay, what was also hammered in the pre-market, initially in the pre-market, the Qs were down. They exploded higher and then faded on the day. Okay, people. What you're actually seeing here, all right, it's just this. It's fractured markets. And that's exactly why I actually wanted to preface the discussion and give you kind of a quick market update over here, because what matters right now, you know, it's not what you think about the QQQ. It's not what you think about the S&Ps. What matters right now, it's the bonds, okay? It is very, very evident that the credit markets have actually gripped hold, and those bonds are going to be influencing both the S&Ps and the NASDAQ in a big way. But the interesting aspect of all of this, and the summation of it, if the market is literally fractured, if the bonds head one direction, tech may rally, okay? And at the same time that tech rallies, the financials could turn around and sell off. And if bonds head the other way, and again, I don't want to go too detailed on this, but if the bonds head the other way, well then, the financials explode to the upside and then tech gets hammered over here. But in any way you want to put it, okay, you're like, oh, that could be positive for the marketplace in both places. All right. And that's exactly what we're going to detail over here. First and foremost, if you look at fractured markets, one of the things I want to detail, and I do all the time, happens to do a tremendous amount with the S&P 100. The 100, the advanced decline line, okay, even though it closed on this Friday in a stellar up market, like let's not diminish the fact that the S&Ps were up, 0.8%. Don't diminish that. I mean, listen, it was a rip and move. But the advanced decline line refuses to correlate. Okay, and one of the big takeaways from this, and again, this is what's kind of missed. I know that a lot of people, they just glance at the advanced decline line, they're like, oh, great, Don. Great, Don, 80-20. Now, what I want you to see in here, okay, look at the ranges. Look at the ranges. Some of these stocks were down huge, up huge. All right, dogs and cats living together. The indecision, it's everywhere. And you can actually feel, like if you've been trading for a while, you can feel the marketplace literally coming apart at the seams. It's literally fractured. Now, yes, it is still grinding higher. And I'm not, by the way, I don't want to in any way, shape, or form portray a bearish case for this. Okay, I'm actually going to look at that here momentarily. The fracture inside of the marketplace, though, it has been split apart by this incredible dynamic that bonds, okay, and the entire world is grappling with. Like, okay, are we actually going to see, inflation, which everybody assumes, of course, is already here. Look at the price of lumber. Look at the price of anything out there, right? Toilet paper, man. We're back to talking about toilet paper. All right. You're like, didn't we leave that a year ago? Absolutely not. Are we talking about inflation? We're going to be looking at a slowing economic recovery. Okay. And that is going to be, that's going to be like, the media's headlines literally for the next month. That's all they're going to talk about. And they're not going to get any, deeper data until, of course, either the next jobs numbers, of the GDP numbers. Okay. We did actually see that consumer credit was actually skyrocketing. If you guys are unaware of when I say consumer credit, credit card balances have actually skyrocketed in some of the most recent data. In fact, for the last year, everybody's been paying off their credit cards. Apparently, that is no longer the case. So again, we're going to be grappling back and forth between inflation and a slowing economic recovery. And it is going to further kind of fracture these marketplaces. Let me show you what I mean by a fractured marketplace. Again, if we bring up the auto expected moves really clarify just this. And we're actually going to highlight for a second. This is this week of trade. Okay. You have to realize the QQQ, was breaking down. We talked about this on Wednesday evening, broke down. It jumped back inside the expected move. Okay, but at the exact same time, take a look at the financials. The financials outside, every ounce of room that the QQQ gave up and that tech gave up was recovered, okay, by the financials. And with the financials goes none other than the energy sector. The energy sector outpaced everything, okay, of magnitude this week. This is like 2.5 deviation kind of territory, people. Put on your big boy pants out there. And to really see the fracture, though, in here, again, when you start looking at stuff like spiders, okay, or in this case, it's always more effective to pull up the SPX. The SPX just a hop, skip, and a jump away from the upper edge of the expected move. Right? You just saw that the financials were outside their expected move. The energy sector smoked the expected move. What did the Russell do? Okay, the little engine that could in here, we'll actually snap expected moves on there. Quite ironically, the Russell stuck in the middle with you, actually finished the week entirely and utterly flat. You are now 1, 2, 3, 4, 5, pretty much 6 weeks into no movement whatsoever inside of the Russell product. Just channeling back and forth. There are some opportunities, though, bubbling up in these markets. So when you look at this, you're like, well, what does this amount to with a fractured marketplace? Exactly. What does it amount to? Okay. Everything amounts to what this bond market is going to be dictating literally the days to come. So what we want to kind of do is portray simply this. Where are we headed this next week? Like, let's not, curb around that too much more, and let's go right for it. Where are we headed next week? One of the first things I want you to think about is, because we actually kicked into high gear inside of the S&Ps. Again, it's not really the S&Ps that kicked into high gear. What really kicked into high gear is unequivocally the financials. And I have been in a short position in those financials, and the financials still finished 0.5% higher, but on the week they exploded higher. So there is possibly a bullish gamma squeeze ahead. Okay, and what a bullish gamma squeeze would kind of mean, and I do want to clarify this because I've been talking a lot about gamma squeezes. Okay, first and foremost, gamma squeeze does not necessarily mean that we're always going to be bullish. Okay, but in this case, I am very clear there's a bullish gamma squeeze. Okay, it started unquestionably on Friday. You got to break lower earlier in the week, or we're going to explode higher, people. I'm just going to clarify that for you right now. Okay, if we even dribble slightly higher, we're actually going to catch fire. Okay, you're going to 4,300 inside of the S&Ps. Just throw a round number out there. There's no reason to kind of go any further than that. There's no Fibonacci's, no MACDs, no Bollinger Bands in here. Okay, actually, if you are into Bollinger Bands, this is where we may actually start to bulge outside of it. But you are looking right now and staring down the face of a fairly significant squeeze. What happened is, again, this huge ball of risk that I've been talking about literally since last week. We told you that the marketplace was positioned. Literally, that was the title of last week's update. Get ready for a big move. Okay, so we snap to the upside, like literally, like that rubber band just snaps to the upside. If we just trickle ever so slightly higher, we rip. Okay, and we rip right to the upper edge of this expected move, which we'll talk about here momentarily. Okay, that is not necessarily set in stone. Okay, you could come right back off into 4180. We're not completely free and clear. We need to get launched just a slight bit higher. Okay, then we're actually just going to rip for it. So it's break earlier, lower in the week. If we just go into this really humdrum kind of like trickle trade to the upside, we're going to explode. There's just no question about it over here, okay? There's too much gamma risk right now not to actually see us. But we've had some catalysts, okay? So in some catalysts, there could be catalysts over the weekend that could actually take the marketplace right back down into the 4180, and we can go right back into this, sit and wait kind of mode. So you have to be incredibly careful because, again, we are absolutely unequivocally leaning now towards a bullish gamma squeeze ahead, which means if you get the opportunity to hedge some positions, okay, you need to do so early in the week. So hold your allocations. What hold your allocation means, okay, if you're firing off a bunch of positions out there, whoa, hold on there, cowboy. If you're going to get a big bullish gamma squeeze, shouldn't you actually wait until we actually do explode, in fact, higher before you start to allocate? Doesn't matter whether you're bullish or bearish, right? And listen, you either got to close some shorts if need be, or hedge. Hedge now or forever hold your peace because, again, on Monday, we could come screaming out of the gate. It could be too late already. We could come screaming out of the gate on Monday and just head for the upper edge of that expected move almost immediately. Now, next in the docket over here, VIX hedges. Okay, get them if you need them. The VIX is incredibly low at this point in time. So how low? Okay, yeah, there's been a couple of prints just, a few weeks earlier that were lower than this, but the VIX collapsed back down. And need I remind everybody looking at the 3-year, we're all the way down to pre-COVID times on the VIX. But this is it's going to be a nice opportunity if the marketplace does continue to kind of rip a little higher to actually put some VIX hedges in place. So, buy it while it's hot. I'm actually going to be a little bit in terms of on the edge on this one. I may wait a few days before I actually execute into the VIX hedge. And the reason I may wait a few days before I execute into my VIX hedge, and what I'm actually talking about is I plan, and I want to kind of clarify, I kind of plan ahead. And I think to myself, hey, listen, if the S&Ps are going to trickle a little higher, they're going to explode higher. If they're going to explode higher, that might take to kind of midweek, and I'd be able to actually purchase VIX hedges. What's purchasing a VIX hedge mean? I'm out there purchasing VIX hedges because I have every intent of actually selling a bunch of premium in the S&Ps later and throughout the course of the month. So get them while you can. But those VIX hedges, look for them probably midweek, and of course I will fire those out to all that are TheoTrade clientele. All right, let's kind of continue. I just wanted to give just a really brief discussion about crypto, because there was something that really that struck me in crypto. I thought that was incredibly important. Believe me, we're not going to be talking about crypto week in and week out unless it does something stellar. And there was something that was, I thought, fairly stellar inside of crypto throughout the course of this week, and I'm actually going to show it to you. And that's this. All right, so push aside whatever you may think about crypto. Listen, when it comes to crypto, one of the coolest things is you can now actually trade it seamlessly, okay, on the Tastyworks application. I mean, crypto and most of your coins, or most of the in-play coins, are actually available in here. Neither here nor there. One of the things that I wanted to mention on this weekend's update, it's right here. Crypto actually ripped. Crypto ripped at the exact same time the jobs number came out. So for those of you that have had this belief that, when the world comes to an end, I'm going to be here with crypto. Crypto is now actually seeing correlation coefficients with other portions of the marketplace. So crypto is being assimilated, if you will. Like, you have to understand, the S&Ps, the bonds, it is like the Borg, people, and you will be assimilated sooner or later. And that's the one point that I want to make. And again, I know I'm going to get 500 emails about this for all the people that are like, you leave my Bitcoin out of that discussion. Okay, that's all well and good, but you're going to start to see the correlation coefficients of Bitcoin and major portions of the S&Ps. Yeah, it's going to pick up. It's going to pick up because Bitcoin, just as I showed you a moment ago, once you can actually trade this in an electronic exchange that is real, meaning that once you can trade it seamlessly, you can trade a stock. I mean, on Tastyworks, you can trade a stock, right? You can trade an option. 2 seconds later, you can actually sling, a little bit of Bitcoin. And when I say sling it, I mean literally it trades exactly like the other products. once you do that, it makes everything so much more like seamless. The correlation coefficient is going to pick up. Algos will start trading it, and it's on. Okay, and I just want you to know that the correlation coefficient's really picking up inside of Bitcoin versus the S&Ps. All right, the other aspect over here, and I mentioned this earlier in the week, but I think it's worth one more mention, because frustration is absolutely there. The micro, okay, I mentioned micro Bitcoins last weekend. It's dead. It's DOA, dead on arrival, people. Now, I know that the contract itself, you look at this is the first week of trade inside of the micro Bitcoin. I don't want to make a big deal about it. I probably will never mention it again on here, but the reason being, it's doing about 20,000 contracts a day. So what's the beef? I'll tell you exactly what the beef happens to be. The beef is a very simple one. The fees to be able to trade the micro Bitcoins, it's $2.50 is the exchange fee. Yeah, forget that. That's actually double my commissions. So somewhere the Chicago Mercantile Exchange had gone and lost their freaking minds. They're charging, at least I have a negotiated commission rate because I trade a lot of futures contracts, but they're going to charge me double. The exchange fee is double my commission fee. Forget that. It's just, I mean, like, do you realize how expensive this? $2.52. Listen, it's $2.50 goes to the CME. Like, so it's $5, like round turn. It's a micro. Okay. Oh, I know. It's a much more volatile instrument. Okay. Except that the brokerage firm actually takes all the risk along with the primary clearing firm. Nevertheless, I'm done. I'm not going to be trading any micro Bitcoins over here. In fact, I think the CME completely failed in the product, and I'll actually be using Tasty Crypto on that particular front. So enough of the crypto discussion. Last but definitely not least, each and every week we look at the SPX Expected Move. There is something actually to kind of mention on this front that I find, well, entertaining. Okay, how many weeks do we have now inside the expected move? So markets have tendency to move through periods of incredible efficiency, and then they actually just rip apart and go to inefficiency. Everything that you see that's highlighted, like this is highlighted and this is highlighted, okay, and that's highlighted, and there's actually a little highlight right there, but those highlights, okay, are indicative of smashing through the expected move. Well, one of the interesting things is we haven't done that. We haven't done that in a couple of weeks now. So you are basically, your 1, your 2, your 3, your 4 weeks. Okay, 4 weeks without smashing through the edge of an expected move. Now, we did actually threaten the lower edge of the expected move. We threatened the upper edge of the expected move. Previous week, we did nothing. The week before that, we actually did crack lower. But what I'm saying is we haven't had a full-fledged breach. Okay, but I am going to say this as well. Just because we haven't breached the expected move in 4 weeks, in no way, shape, or form does that delineate that we're going to break through the edge of the expected move. But here's the interesting aspect. They crushed the expected move for the coming week, okay, down to like $61 and change. So we just came off of a $67 expected move, and we had some big boy movement throughout the course of this week. We rallied back up, but coming into this week, we only have a $61 anticipation of movement. Volatility is inherently low, and the more that volatility collapses, well, listen, we're on the verge of the possibility of a gamma squeeze. In the very, very short duration, you want to be a net buyer of premium. Like if you're trading out for 1 week in time, like if you're trading anything like a week out in time, you want to probably be a buyer of premium. Any further than that, you could probably be a seller of premium. But in the short duration, in the very short duration, make sure that you're long gamma right now. This is dangerous. Again, we've got jobs, we've got Fed. There's clearly a market of denial in here. Good news is bad news. Bad news is wonderful news for the marketplace. Hey, listen, anything that's been thrown at this marketplace, it has been the Teflon market. Nevertheless, right on the verge, again, of that gamma squeeze, a bullish gamma squeeze to the upside. Keep that in mind early in the week. It is literally coming down to kind of Monday, Tuesday, Wednesday of this trading week to kind of tell us, is that gamma squeeze going to grip hold and rip us a little bit higher? That's it for this weekend's update. Thanks everybody for joining us here at TheoTrade. Have a wonderful weekend. Happy Mother's Day. Bye-bye.